In Chapter 5, we're going to start talking about deductions for AGI and deductions from AGI. This is where a lot of tax dollars can be saved, especially on the deductions from AGI, because that's where we get into our itemized deductions that we briefly talked about in earlier chapters. And this is where a lot of people have a lot of questions. You know, they hear from their hairdresser or their bartender that they can deduct this or that. And a lot of times it's usually not true, but this is where we're going to learn what we can and cannot deduct from AGI. Okay, so let's start looking at deductions for and from AGI. Remember, we start with our gross income, we subtract the easy deductions, which are the ones that are for AGI, and that equals our AGI. The deductions you can take to arrive at AGI are your self-employed health insurance, which we'll look at here in a minute, 1/2 of the self-employment tax, which we'll talk about, and student loan interest deduction, etc. We're going to look at all these here in just a little bit. And then after you arrive at your AGI, then you deduct the deductions from AGI. And that's either or, remember, either your standard deduction or your itemized deductions. And then, of course, under et cetera, that'd follow that QBID that we talked about last chapter. So let's start looking at a few of them. The first one we're going to look at is our health savings account. This is a special type of savings account that allows you to pay for unreimbursed medical expenses. Unreimbursed usually means, you know, you weren't covered by insurance for it, or maybe it was a small thing and so you didn't use your insurance for it. And that's where you can use your HSA. A lot of big employers will give their employees an HSA account to cover their deductible. They do this oftentimes to encourage you to choose a high deductible plan because it's a lot cheaper for them. I know one client of mine has a $2,500 deductible medical insurance plan, but their employer gives them a $2,500 HSA. And they do that because it's just so much cheaper when you have so many employees. It's a lot cheaper to get a high deductible plan and just pay your employees through an HSA to cover that deductible. And so that's what they did. They don't have to do that, but that's what they did. And some HSAs are not funded by the employers, but by the employees themselves. So it must be a high deductible plan. And that threshold, I believe, is $2,700 or so for married filing joint, and about half of that for single filers. So if you have a deductible in that range, then you can get an HSA. If you contribute to an HSA, then those contributions may be a deduction to you, and earnings in your HSA are tax-free. And as long as you use the distributions for medical expenses, you are not taxed on those. So you get a nice pre-tax benefit for your contributions, you get some tax-free earnings, and then as long as you use it appropriately, you are not taxed on your distributions. HSA deductions is for AGI. Apparently I can't type, that should be is. HSA is a deduction for AGI, so it's an above the line deduction. Some of the limits on it, you can't deduct it, or excuse me, here's your deductions on it. You can deduct up to $6,900 for family, or $3,450 if it covers just yourself. If you're over 55, you can add in an extra $1,000. And if you're over 65, you can't make any contributions. I don't know why. I think it's because now you're going to be covered by Medicare, so you really don't need the HSA when you're 65 or older. And then, oh yeah, here's your minimum insurance deductible. So here's the thresholds. They may have adjusted for inflation. A lot of the things in the IRS tax code does adjust for inflation every year. So these have probably gone up just a tiny bit. And then distributions, what can we use them for? Well, pretty much anything that you do medically related will qualify. Elective things, of course, are not going to qualify for it. And distributions that you don't use for medical expenses are subject to income tax and, of course, a penalty. IRS loves penalties. So if you need the money for whatever and you take it all out and it's not for medical expenses, you're going to have to pay income tax, which for most people is 12 to 15%, and you're going to have to pay a 20% penalty. So right there, you lose 35% of your contribution. If you take distributions after you turn 65, you pay no income tax, you pay income tax on it, but no penalty. And so now they're just letting you take it all out since you've turned 65, and you probably don't need an HSA anymore. All right, so that's a quick look at what an HSA is and the deductions on it. Next, we're going to look at a self-employed people, and when they pay health insurance, how they can use that deduction for their tax benefit.